Hi, welcome for joining us for this wonderful webinar on structuring audio-visual expenditure credit for cash now, not later. I'm Barry Dowsett. I'm the founder and CEO of Myriad. I'm also a chartered accountant with SEMA and also a member in practice. Now, if you've not already seen our first webinar, which is all about the fundamentals of AVEC, that is available now on YouTube. So once you obviously watch this webinar, you feel like you need to look at some fundamentals, please have a look at that. It covers a lot of the basics and is also very insightful. In terms of questions and answers, we'll have a live session towards the end of this webinar, and you can put your questions in as and when they crop up. But yeah, thank you for joining this morning for this webinar, and I'll just crack on now. So as I said, this is about structuring audio-visual expenditure credit to ensure you obtain cash now, not later. And I'm just going to move on. Apologies for that. There we go. So what will we cover today? The first thing I'm going to touch on is why does the AVEC actually get delayed? The value of the AVEC that gets delayed. I'm going to propose what the best-in-class solution is, show you how that works in practice, which will be supported by some numerical numbers, and then also what is extremely important is the agreements and records that underpin that structure. As I said at the end, we'll answer your questions live. My colleague Chris will join us for the last parts because he is our in-house resident BFI expert and also one of our cost analysts. So he'll be able to answer some of those questions if they do relate to BFI. But as I said, this is all about how to structure AVEC for cash now, not later. Okay. So I suppose the first question is, why does AVEC cash get delayed? Well, it's all to do with the reporting, the tax treatment for HM Revenue and Customs, and that is that each qualifying production, so it's each production that qualifies for AVEC, has to be reported as a separate trade. So if you've got multiple productions, you're going to have to split out your tax computations into multiple trades. Now, when a particular production is not completed, then what you can't do is offset any losses in that production against other trade and also other AVEC productions. And that's the key here. So anybody that's doing an interim claim, production's not being completed, there is something which happens which is not very nice, and that is that your losses become trapped for that particular accounting period. Now, when that production has finished, yes, you can offset those trapped losses against other trade, but that could be multiple accounting periods. And the amount that gets trapped, which is the next slide, is, and this is the calculation behind that, is the production losses of that particular AVEC trade. That particular production that's not completed is the losses that's incurred, and it's multiplied by the corporation tax rate. So that is what gets delayed. That's what gets trapped, therefore not allowing you to claim that cash in that particular accounting period. So I'm going to move on to the next slide, and this is regarding what is the solution. This is some probably terminology some of you have heard about and maybe even understand, but there's something called a special purpose vehicle, which in its real basic form is another legal entity. And you can have a special purpose vehicle geared for a particular purpose. In this case, it would be the production, whether that's for high-end TV, kids TV, animation, or even VJET claims as well. That's video game expenditure credit. And you can have multiple separate entities split up for this purpose. So the structure is quite simple. You have a parent organisation, or you can have multiple organisations with a controlling interest in a production company. And in this case, it's quite simple. We have three: production A, production B, and production C. Now, the whole aim is to have the SPV to a break-even position in order to ensure that you reduce the amount of losses that become trapped. And that's extremely important. Now, typically what you'll find with a production that is not being completed in the accounting period, of course, it's incurred costs, and therefore it's not got any income to show. But we're going to go through an example in a minute which shows you how you can transfer costs from the parent into the production entity. So here's a very simple example. We have here, before a claim for AVEC is made, so let's assume you're not going to make an AVEC claim in this particular case, and therefore you have just one trade and your income is 10.5 million and your expenditure is 10 million. For this section. So the expenditure here is 10 million, ending up with a taxable profit of £500,000, and therefore corporation at 25%, so £125,000. Now, as I've said before, you have to split out by trade. So at this moment, before we do that, the position here is a corporation tax payable amount of 125,000. Now, the next example I'm going to do is going to be for a television production. So within this is a television production, and I'm going to split out this expenditure into the trade of AVEC, and also what is left is going to be the non-AVEC. So I'm going to take away, or from this expenditure, I'm going to split out £1 billion of production costs for this particular production that's not completed at the year end. So here we have it. Let me take you through this slide. So the income still remains with the non-AVEC trades. This is the non-AVEC traders, all the other trade in the business of this particular entity. What we're talking about is that there's one, as I said, high-end TV production, which is incomplete. So I'm just literally splitting the costs of the 10 million that was originally here. I'm putting 1 million across to the AVEC trade. Therefore, you've got, and that cost is split between core expenditure and non-core, totaling the 1 million. So we're having to separate the production trade away from the main trade, I think, which is obviously non-AVEC. And of course, if you have multiple productions, you'll have multiple AVEC trades. However, so we now ending up here with a non-AVEC trade, so all the other business actually having a taxable profit of 1.5 million. That's because we've taken £1 million worth of qualifying expenditure out of here to separate it into a separate trade, the AVEC trade. So that's £375,000 worth of corporation tax. Now, unfortunately, this means, because there's no income for the AVEC trade, you have 250,000 of corporation tax stuck or trapped with the AVEC trade. Now, you do get, obviously, the enhanced audio-visual expenditure credit, which is calculated as follows. So this is income that you will receive, income that is taxable, and that is derived from HMRC and customs. And that calculation is 80% of your core expenditure, which is the 950. So that obviously is the 760. You have the 34% gross income. As I said, AVEC is subject to corporation tax. So therefore you have 258,000 worth of additional income. You then, from that, have to deduct the corporation tax. As I said, AVEC is subject to corporation tax. It's gross income. So you end up with a net AVEC of 193,800, which is paid to you by HMRC and customs. Now, the issue here is that you've got on the left 375,000 to pay for all your other trade, but you've actually got 193 coming back, which is great. Overall, though, you're in a net position that you have to pay HMRC and customs 181,200, which is obviously not ideal. So if we just go back a slide, and bear in mind it's now we have to pay 181,200. So even though you're making an AVEC claim in this instance, before you're actually a little bit better off. You only have to pay 125. As I said, this all comes down to the fact that 250,000 of your corporation tax here, in terms of reduction you would have achieved against the 3, is trapped. Now, the solution I'm going to run through with you now is sorry, I do think it's right. So the production company, in terms of operating as an SPV, there's some other factors that we have to take into account. There's some compliance criteria that we need to take into account. And the first thing is that an SPV, and this is from the legislation, but also from HMRC and guidance, is that the SPV should reflect real economic activity and simply not act as a pass-through, which lacking control or risk. And that's extremely important. It has to be able to make the key decisions, the management decisions, contract negotiations, and also take on the risk. Now, the production company itself here, set up once through a special purpose vehicle, has to also be production decisions, handle contracts directly, etc. And that's all under section 1179 of the CTA 2000. And the other thing is another criteria in terms of certainly compliance, and something which HMRC and Customs are becoming very hot on. You'll see with the included within the additional information form, is that the connected parties and transfer pricing, and that's all covered under section 1179 DU of the CTA 2009. And the principles here under the guidelines of OECD is it has to be at arm's length transaction pricing. So we have to bear these three elements into account in order to come up with a structure which will allow you to ensure that you're not trapping your AVEC cash. And this is what the next slide will provide you with. So in this example here, I'll go through this step by step. We have the parent and we have a production company that is eligible for audio-visual expenditure credit. And this structure is designed to ensure that you don't suffer from what's called the trap to losses, i.e. particularly for any production that is not complete in the period and you've got an interim certificate for. So I'll start off. First thing that needs to happen, and remember the principles before in terms of the fact that the control, the risk, etc., has to be borne by the production company. And that is something which HMRC and Customs continues to focus on and also accelerate in terms of their compliance. So one of the things that we would suggest here is to make the production company more autonomous, is that you would put in a working capital loan up to the expected AVEC amount. So it's a working capital loan up to the production company from the parent. The parent management and services that are incurred can be transferred to the production company. Once again, that has to be under transfer pricing and that has to be on an arm's length basis. The third stage is that the production company, through the support of the loan, is able therefore to pay the staff, the contractors and the suppliers. Now, the commissioning fee that the production company, and this under a production agreement, is able to pay commissioning fee to the parent. The parent is commissioning production to produce this particular TV show, could be animation, etc. And therefore, the invoice is raised from the production company up to the parent. So the parent therefore is paying what's called a commissioning fee. And therefore the cost incurred and the commissioning fee will balance each other out. And this is the secret behind, not secret, but certainly the mechanism in order to achieve a break-even position. Okay, so then we have 5, which is the AVEC payment is coming through. So you make the claim through the corporation tax return, you do the split out correctly, and the HMRC Customs payment comes through into the production company. And then once that's received, you can then settle the working capital loan repayment up to the production company. That's number 6. The other points to note on this as well is that the production income, which is at 7 here, can also remain directly with the parent, because the income generated from the production company is from the commissioning fee that is being charged to the parent. And then any post-tax profits, if there are any, could be passed back to the parent. I won't go into details on number 8. It's probably a little bit beyond this, but in some cases, and particularly where it related to multiple ownership of production companies, for example, you could be in a position where you want to charge back a percentage to each of the controlling interest in that production company, and that's where 8 would come in. Now, to underpin this proposed structure and funds flow, we would recommend that, and it's important for record keeping, in particular for HM Revenue and Customs, is that you have the following legal framework in place. And this is, as I said, documentation to support your claim if requested. So you would have a working capital loan agreement, intercompany loan agreement, which is obviously quite straightforward. You then have, and this is probably the foundation of the various transactions, is the production agreement. So the production agreement would certainly talk about the commissioning fee. It would talk about who pays for the costs. It would talk about the decision making being with the production company. And also that would tie in nicely with any compliance that is stipulated by HM Revenue and Customs, and that will provide evidence of that. The other thing that we recommend is that you have a transfer pricing policy. So any pricing between the parent and the production company, so anybody that's anybody that's a connected party, would have to be done at arm's length, and that's something that you need to be able to support. So transfer pricing policy is extremely important in this case. One of the things that you need to avoid is any kind of profit being transferred across, unless it's justified by an increased value through benchmarking under transfer pricing policies. And that also, we would say also that you have a management, admin and services agreement, so it's clear what services are being provided to the production company from the parent company. Now that legal framework is becoming extremely important, and through the claims that we support our clients with, we are finding that the creative unit at Manchester is certainly asking for copies of these agreements to justify that the production company is the organisation that is allowed to make that claim. So I cannot stress the importance of this, and I do feel this is something which going forward will become under more scrutiny. Now that pretty much wraps it up. I've been through it relatively quite quick. I'm now going to go across. I'm sure there's some questions coming through. I'm going to go across, and I would also like to introduce my colleague Chris, who hopefully will join us very soon. So Chris is the Myriad's creative industry expert. Chris, are you coming on to the call? Hi, Chris, are you there?
Yep. Can you hear me okay?
Yes, I can. Thank
you.
Hi, Chris.
Yeah, hi, sorry for that.
Hi, everyone.
Hi, I'm Chris. I'm the creative industries tax incentive specialist at Myriad, and I deal with, as Barry's already said, I deal with all the BFI applications as well as the detailed costing analyst. So I'm here to answer any costing questions that might crop up or questions relating to BFI.
Fantastic. Thanks, Chris. So yeah, you've got our emails, obviously. Please take a note of those. And if you want to send a quick email, so you can obviously return that, and you've got all our contact details. That's absolutely fine. And of course, you can get hold of us on LinkedIn as well. Now, I believe we have some questions. So I think Kale's just going to propose those questions. Once again, please put more questions in the Q&A section. So are you with us, Kale?
I am, yes. Hi, Barry. Thanks very much for that awesome webinar. I'm just going to put a message in the chat, just so if anyone does have any questions, they know exactly where to ask them. We do have some that we collected before the webinar as well, so I can go through those.
Perfect.
So one of the questions we got was, can costs which are incurred before setting up the SPV be transferred into the SPV?
Okay, I can answer that one. The short answer is no, they can't, because obviously the SPV is not a legal entity, it does not exist. It could be if it's, for example, if it's an asset, for example, that's been incurred, so you built it up as an asset, so rights, etc. Sometimes they can be transferred across, but generally speaking, if costs relating to the production have already been incurred, you are unable to transfer those across to the SPV because obviously the SPV did not exist at the time. And I suppose the other thing I would say on this, it shows you, I would highly recommend that people set up these SPVs as early as possible. Even if you get to the point where you feel that it's not viable in terms of maybe for cost reasons or other reasons that you don't need to put through or use an SPV, or let's say your production are all going to be completed in the period, fine. If you get one set up, it's there, and therefore it's minimal administration to keep that live. But it's there and it's great, and you can obviously then transfer the costs. But yeah, to answer your question, unfortunately, the simple answer is no, you can't.
Okay, fantastic. Thanks for that. We have had one come through. Could you talk about co-productions? Do you have any examples for calculations?
Yeah, we do have examples for calculation for co-productions, but I think, Christian, coming on this in terms of the UK treaty on co-productions, I think there's a little bit of compliance work to be done, or certification to be done on that in terms of co-production, obviously for UK. So Chris, could you just talk us through co-productions?
Yeah, sure. I mean, co-productions have to be certified before, typically the application has to go in 4 weeks before principal photography starts, but this question seems to be talking more about the calculation. So in terms of the calculations setting up the SPV, it's still going to have the same structure. So your UK company would be an SPV. The advantage of that, from my understanding of this as well, is it will also give you some legal protection. So it's also going to separate your main company, your parent company, from the SPV, which is part of a co-production in line with other companies. However, you will only be able to claim the UK costs for your claim. So you won't be able to claim costs for your, depending on where your partner is, for your US partner, for your partner in India, for your partner in Europe. You'll only be able to claim the UK costs as an SPV. And there are, from what I remember off the top of my head, I think there's about 18 different co-production treaties that you can sign up to, including a generic European one as well. So this whole structure Barry's talking about will absolutely work for your SPV and a co-production. You just need to make sure that you're just claiming for the UK expenditure.
Yeah, just to add to that as well, I mean, setting up an SPV and ensuring that the SPV is the production company, the entity, you can have multiple shareholders of that SPV in terms of who the beneficiaries are. So therefore, profits or the AVEC profit, for example, if you're operating at break even, just looking at the AVEC, can be split to each of those controlling parties through whatever agreements arranged. Typically, it could even be dividends. So there are different structures there, but the key thing is to have a specific, well, SPV, but have that entity set up for that particular production. And then obviously you can then have other, as I said, entities taking a controlling interest or an interest, and therefore split out by share dividends. So yeah, absolutely.
Awesome. And another one we have here is, can an SPV be set up with multiple owners, and how is the AVEC shared between the owners?
Well, I pretty much just answered that one, actually. So just to recap on that, so you have, you can have one production company being the SPV, and then you can have multiple owners of that, each taking an equity piece, and therefore you can pass back the in terms of dividends. That's one route, one which we have used, and sometimes you may have charities involved as well. So there's always this deed in terms of for gift aid purposes, if you've got a charity company involved, but that would mean setting up the company as a charitable company status. But that's something which obviously it's a bit too far for this, but it is possible. Once again, it all comes back down to setting up the correct corporate structure and also making sure you do the planning in advance of the production itself.
And then the last one I have here is, what costs come under AVEC?
Oh, I'll jump in and take that as that's my area. So in terms of the costs you can claim under AVEC, it relates to two different areas. One is what stage of the production cycle are you in. So you can claim during the actual production cycle, which for AVEC is typically principal photography, pre-production and post-production. So conceptual development or just developmental work you can't claim, but once a project hits what's referred to as its greenlit phase, so you've got most of the financing in place, and the commitment now is we're now going to go and make this. They're the cost. That's the stage when you can start looking at claiming costs, and it's all the costs related to the production. Specifically, it's the core production costs that you can claim the relief on, and this will be things like sets, studio hire, casting, crew, the planning of all of those things, so your location scouting can be claimed as well. You can also include, and what a lot of people miss, and they also miss out on their budgets when they're putting it together for BFI, is they miss the overhead costs, because you can also assign your overhead costs on a fair and reasonable apportionment basis as well. So if you're renting offices, if you've got staff that are involved in this, you can also just claim their time as an apportionment of that. And the other costs we can't claim are things to do with the commercialization of the production, so marketing, auditing, all of those kind of stuffs we can't claim. And as I said, for the purposes of the relief, it's going to be that core expenditure, although we do need to report on all the expenditure, because that will actually give us our trade, as Barry's spoken for already, which is very important for getting ideally to a break even. So we do want to report on those development costs, and we want to report on those commercialization costs, because that gets us closer to either being loss making or break even, which is the ideal situation.
Great, thanks, Chris. We've got another one just come through for the overheads. Again, the question is, I guess it must be disclosed on the production budget, correct?
Ideally, yes. I mean, in terms of what we're doing when we're reporting to HMRC and BFI, we'll actually report that the spreadsheet that's available, and probably most of you already downloaded, so our template actually shows that. If you look at the studio cost section, and the apportionment method you would use generally is staff time in the active production phases. So when you've got your staff cost, what is that as a percentage of the total staff costs for that year? And that ratio is your ratio you're going to apply to your qualifying overhead, so studio hire, phones, etc., just general software, all the general stuff, power and heat, you would apply that rate to there. So ideally you'll show it in your budget, because then BFI is getting a more accurate one, but it absolutely should be in your breakdown that you're supplying to HMRC.
Okay, thanks for that, Chris. I don't have any more questions, guys. We answered the ones that came in pre-webinar. It doesn't seem like there's been any more submitted. So yeah, over to you guys.
Okay, first of all, I'd like to say thank you for everybody spent or sharing some of their time with us this morning. I hope you found the webinar insightful. Now, as I said, we do have a fundamentals AVEC, which is live on our Myriad's YouTube channel. And we're here to obviously answer any questions that you have in terms of going forward as well. So you've got my email address, you've got Chris's email address. Feel free to send us a quick email, even if you want to get our contact details back in terms of our other contact. You can do that. We'd send one quick one back to you. We're all about delivering educational and insightful content, and I hope you found this is very useful. I'd like to wish you all the best and enjoy the rest of your day. So it's goodbye from me.
And goodbye from me.
And goodbye from Chris. All right. Thank you, everybody. It's been a pleasure. Thank you.
Bye.
Yes, bye-bye.